Are you prepared if financial disaster strikes? Well, if you're like most people, the answer is probably not. So if you want to be one of the few who are, then be sure to watch this training, and that way you can be prepared. So I've created this course years ago. This is the fourth video in the series, and we're going to talk about a lot of important things. And I tried to make the training fun and interactive, so hopefully you can learn some things while having a good time, or at least that's the goal. So in this training, I'm going to talk about emergency funds, different types of insurance, how health insurance works, estate planning, taxes, the 4Ds of disaster, identity theft, and a whole lot more. So if you want to be prepared in case disaster strikes, be sure to watch this training, but don't just watch it, actually take action on it, so that if something does bad happen, you'll be prepared to the best of your ability. And if you enjoyed this content and you take action on it and you get a positive result, I'd love to hear about it down in the comments below so that I know that people are benefiting from this training. So we'll dive in here. I hope you enjoy, and I'd love to hear from you. Welcome back to the Family Treasure Chest. This week we are preparing for the worst. Who wants to be prepared for anything, survive financial disasters, avoid stress, and be in control when problems occur while staying calm, cool, and collected? Make some noise if that's you. Right, so we're going to cover many things this week. Going to talk about the emergency fund, types of insurance, healthcare, estate planning, taxes, the 4Ds of disaster, identity theft, and much more. Okay? But first, let's talk about accountability. So, how'd the homework go? Did you implement your get out of debt plan? Did you check your credit score and your credit report? Are you following your budget? Or do you continue to have an unstoppable mindset? Did you take action towards your 8-week SMART goal? Did you read chapters 11 through 15 of Pirates of Financial Freedom? Let's find out. Why don't you share how the week went for you? What action did you take? What results are you seeing? Because this is all about getting results. And obviously, if you don't take any action, you're not going to see any results. So go ahead and keep each other accountable and update each other on how the book reading went and how things are going. Okay, great. So I'll be talking about taxes and legal things. Again, this is just meant for general guidance. There's no advice given, so I encourage you to speak to a lawyer and an accountant when it comes to your specific situation. All right, first, let's talk about emergencies. And a lot of times emergencies will happen, and that is why you want to have an emergency fund. Basically, emergencies are going to happen to everyone eventually at some point. Not having money when one occurs will make a stressful situation even worse, okay? So if you have to if you have to go to the hospital and you have to pay medical bills, or if you have to fix something that broke, or you have to take a trip for something, and you don't have any money there, well, you're already under stress because of the emergency, and now you're under even more stress. General guideline for how much you should have in your emergency fund is about 3 to 8 months worth of expenses. So emergency funds are often used when you lose your job. So add up all your bills, and since you have a budget now, you know what those are. And let's say that you need, $3,000 a month for your expenses, or whatever the number is. 3 months would be $9,000 worth of, basically $9,000 of cash would get you by 3 months. So if you lost your job, you would be able to pay all your bills, pay your rent, etc., and survive for that long without an income. Basically, 3 to 8 months is the general guideline. And you want to take into account your industry's employment opportunities, right? So if, the economy is booming and you're in a section of the economy where it's easy to get another job, then, maybe it can be closer to the 3 to 4 months of expenses because, you can get another job right away. But if unemployment is high and you're in an industry that's not doing very well and there's not a lot of hiring, then you're going to want to be closer to the 7 to 8 months of expenses. So you kind of want to factor it based on basically how easy it is to get another job in your industry. Some people want to know what they should do with their emergency fund. Should they invest it? And generally speaking, you don't want to invest it. You want to leave it in cash or some sort of short-term like cash that can be converted to cash very quickly, because let's say that the stock market crashes, okay? And then your company's stock price goes down a lot and then they lay you off, all right? You don't want that emergency fund to be in all stocks, because now, let's say it went down 25%, your emergency fund is, you lost your job, the stock market's down, your emergency fund lost money. You don't want to take that kind of risk. So just leaving it in cash is probably the best idea. Now, building up a true emergency fund you might need over $10,000 of savings for a fully funded emergency fund. And that takes a long time to build. So if that's overwhelming to you, just do the first step, which is save $1,000. All right, that should be your first goal. At least have $1,000 in that emergency fund to start off with. Now, the thing about an emergency fund is when the money is there, it seems like, let's say you build up the $1,000 and then something happens and you have to spend it back and you have to build it up again. That's what the emergency fund is there for. And that's probably going to happen a couple times. So don't get discouraged, okay? Sometimes people build up an emergency fund and they have to use it right away. Well, that's fine. That's what it's there for. So if that does happen, just keep building it up again until you can get to that $10,000 mark. And what's funny is once you have a fully funded emergency fund, emergencies tend to happen less often. I don't know why that happens, but a lot of people say that. So if you want to prevent emergencies in your life, have a fully funded emergency fund. So what is an emergency? Let's say you get in a car accident. Let's say that you have medical expenses that are unexpected, or you have a death or sickness in the family and you need to fly somewhere to be with them. These are types of emergencies. Some emergencies are predictable. Like, for example, some people consider an emergency, well, my car broke down and I can't get to work and I need to go to work, so this is an emergency. I need to fix my car. Okay, that's valid. That would be a quote-unquote emergency. But some of these quote-unquote emergencies are predictable, right? So your car is going to eventually have maintenance, so you should have maybe a separate savings account just for those types of things. You know that your roof on your home is eventually going to need to be replaced, all right, at some point. So it'd be good if you put in your budget things that you know are going to happen eventually. That way, when they happen, it's not an unexpected emergency, it's a planned expense. Fun things are not emergencies. Okay, so your friends are going on a trip and you need a quick $1,000 to go with them because this is a once in a lifetime opportunity to go on vacation to the beach with your friends. That is not an emergency. Okay, do not use your emergency fund for fun things like that. If you want to do that, start a fun account for unexpected fun opportunities, right? So you have your emergency fund, which is for true emergencies. And then you have your fun account, which you put in maybe $100 a month into or whatever your budget allows you to do. So that can build up over time. And then when you have an unexpected fun thing occur, you can draw from the fun account. But don't touch your emergency fund unless it's for a true emergency. Let's talk about insurance, right? If something bad happens, we're preparing for the worst. Insurance is a vital component to being prepared. So what are different types of insurance? Car insurance is one, right? Let's say that you have a $10,000 car and you get into an accident and then you have to get a new one. Having car insurance would be very helpful because otherwise you'd have to spend $10,000 on a new car, whereas with insurance, they're going to cover a lot of that. Homeowners or renters insurance. Right? If you own a home and something happens to your home, you obviously want to have insurance because you don't want to buy a new $200,000 home if something bad happens to it. You also want to have renters insurance, right? So if you're just graduating from college or if you're in college or you're living somewhere and you're renting an apartment, renters insurance can be very important. A lot of people forget that, and it can be very cheap as well. Now, for both of these insurance, you want to have kind of an inventory of your assets. And an easy way to do that is to just take your phone and take a video of everything that you own, right? Because if everything were to get stolen or were to catch on fire or whatever, the insurance company is going to want to have proof that you actually own the things that you said you owned. So an easy way to do that is to just take a video of it. For homeowners, you also want to factor in flood insurance. Floods are usually not covered by homeowners insurance, and floods can happen anywhere. I mean, think about all the storms and the hurricanes that are going on. It's said that 1 inch of water in the home, just 1 inch, could cause $20,000 worth of damage for an average home. And that's a lot of money if you don't have protection. So kind of ask around your insurance agents in the area, see if you're in a high-risk zone for flooding, and even if you're not, you may want to consider getting it. At least get some quotes on flood insurance. Another type of insurance is disability insurance, and there's basically two types of disability insurance, long-term and short-term. If you have a job, you want to ask if you get disability insurance because that's great. What disability insurance says is, let's say you get hurt and you're unable to work. You're disabled temporarily. Well, if you can't work, then you're not getting paid. So what disability insurance says is, okay, if you get, if you break your leg and your job requires you to do a lot of walking or whatever, and you're unable to do your job, it will supplement your income for you. There's lots of different types of policies. Maybe it's you get 65% of your paycheck while you recover, right? And you're going to want that part of your paycheck because you still have bills to pay. Just because you can't go to work, your landlord still expects you to pay rent. So short term is meant for, a couple months, 3 months, up to a year, something like that. Long term disability insurance is meant for years at a time, right? Maybe for the rest of your life or until you reach 65, or all the policies are different. You'll want to kind of look at the fine print and see how it's covered. But having disability insurance can be very important because if something does happen to you, you still have bills. And if you don't have an income, disability insurance is meant exactly for that purpose. And a lot of times it's not that expensive. When you sign up for your job, you may have the option to pay an extra, few dollars a month to get additional disability insurance. That could be a good decision depending on your situation, right? So for example, maybe if you pay some extra money per month, normal disability would cover 65% of your income, but if you pay a little extra, it might cover 75%. Or whatever the numbers are, right? It really just depends, but that might be an example. And if you actually do become disabled, having that extra income coming in, you're going to be thankful that you did that. Next is life insurance. Okay, so if you die, you get a certain amount of money, and we're going to go into more detail on that. And then obviously health insurance. So if you get sick or you have to go to the hospital, have to go to the doctor, covering those types of bills. And we'll go into more detail on that as well. One thing that I'll just mention here is long-term care insurance. With long-term care insurance, it's meant for, when you're older, so when you're mostly for retirees. And what that is, you probably want to start shopping around for it when you're in your 40s or 50s or maybe 60s, depending. And what that says is, let's say you end up in a nursing home. Well, if you have grandparents in nursing homes, you know how expensive they can be. And a lot of people don't have that amount of money that they can just pay out of pocket for nursing home and for extended care like that. So long-term care insurance is meant to help cover those expenses. And it can be kind of expensive. And there's certain fine print in a lot of those policies. So you want to do your research, but it could be something to look into. All right, let's cover life insurance. There's basically two main types of life insurance. There's whole life and term insurance. So let me explain the difference. Whole life says you pay a certain amount of money every single month, and if at any point you die, then you'll get a certain amount of money. Let's say you have a $500,000 whole life policy, and so if you die tomorrow or 100 years from now, whenever you die, you're going to get that your heirs are going to get that $500,000. That's whole life insurance. Term insurance, let's do the same example for $500,000. Term insurance says you'll get that $500,000 if you die within a certain amount of time. So let's take a 20-year term insurance policy, for instance. Okay, so if you die anywhere between now and 20 years from now, you'll get the $500,000. If you die after 20 years, then you don't get any money. That's kind of the idea. So you may say, well, why would I want that? And for parents, this is great. Term insurance, right? Let's say you just had a few babies, or you have some young children at home. Until they're 18 or can take care of themselves, you're going to have to support them. But once they're on their own, then they can get a job and support themselves, and you don't really need to take care of them anymore because they can take care of themselves. So that 20-year term policy is great for parents, because once the 20 years is over, they're pretty much good on their own. And an advantage of term insurance is that it is a lot cheaper than whole life insurance. So you definitely want to have insurance if you have kids, because let's say you pass away. That's less income. How is your family going to support itself? How are the children going to be taken care of? How are you going to pay for their college? How are you going to pay for the mortgage? So you want to make sure that you have the proper amount of life insurance, especially if you're a parent. Now, how much life insurance do you need? That really depends. Oh, and another thing is, children typically don't need life insurance. Maybe they want a small policy to cover burial expenses. But generally speaking, children don't need life insurance. Again, I'm not giving you advice. You want to double check on that. But a lot of these insurance people will try to get you to say, "Oh, you just had a baby, so you want to get life insurance for the baby under their name." Generally speaking, you probably don't need that. All right. So how much life insurance? That depends on many things. Does your spouse work? So if you are the sole breadwinner of your family, and your spouse does not work, then you're definitely going to need life insurance, because if they're not working, where's the income going to come from? Now, the other thing is, maybe your spouse can go back to work if you were to pass away, then maybe you need less of it, but you kind of need to think that through. If you have young children, you definitely need life insurance, okay, for the most part. Do you have a lot of debt, right? So if you have a large amount of debt, you may want to have more life insurance. What future expenses are you going to have? You want to kind of do the math on that to say, all right, well, we're okay now, but 10 years from now, we're going to have this large expense. And so we might need extra life insurance to cover that. There's lots and lots of different factors to think about. But a rule of thumb is, and this is just a rule of thumb, it's different for everybody, but a general rule of thumb is 10 times your annual income. So let's say you make $50,000 a year, you'd want to have at least $500,000 worth of life insurance. But again, it really comes down to, you have to do the math. This is just a math problem, right? So figure out now that you have your budget, you know what your expenses are, you know how much debt you have, really add up to see how much life insurance would you need. And there's no way to do that except actually going through the math to figure it out. Another thing you want to keep in mind is some people say, well, I have life insurance through my job, I'm fine. But they don't know how much they have, right? If you only have $100,000 through your job, that might not be enough to cover your family if you've got a few kids that want to go to college someday, right? That $100,000 is going to disappear very quickly. And what happens if the worst case scenario happens, right? Things are going badly, you lose your job, and then you pass away the next day. If you want to check your policy at work, but if you're not employed there anymore, you might not get that life insurance, which means now your family has nothing. So maybe having an outside policy may or may not make sense. You'll have to do the research for yourself, but that's also something to consider. All right, so let's talk about health insurance. You always want to carry health insurance, right? So especially young people that just have their first job, they may say, oh, I'm young and healthy. I don't need to worry about health insurance. That is a big risk you are taking because a $50,000 medical bill could just come out of nowhere if you get into an accident, and how are you going to pay for that? So having health insurance is very important. A lot of times you can be under your parents' policy up until the age of 25. You want to see if that's true where you are, but that's obviously a great thing. So you want to see if that applies to you, but regardless, you always want to have health insurance. Employer-provided health insurance can be a great benefit. So when you're looking for a job, you always want to see what benefits are included, right? And one of the benefits would be health insurance. You want to kind of see, is this company providing good health insurance or not? And you can kind of, if you're not sure if it's good or not, you can ask around to your friends and your family and say, hey, what does your health coverage cover for your employer? How does it compare to mine? And they'll be able to say, oh, that sounds really good, or oh, that doesn't sound good at all. Just kind of asking around, you can learn a lot. If you have a specific doctor that you really like and that you've been going to for years, when you sign up for a new health insurance plan, you want to make sure that doctor is covered, right? There's this thing called in-network and out-of-network when it comes to health insurance. Basically, these health insurance companies have combined, and they say, all right, if you go to this list of doctors, you're going to get cheaper care. But if you go out of network to doctors that are not in our network, it's going to be much more expensive. So you'll just want to see, now maybe you're fine with switching doctors to somebody new, but you'll at least want to know if your doctor is covered or not. Let's go over some important terms and concepts in health insurance because this can get kind of confusing. The premium. The premium is how much you pay per month to have health insurance in the first place. So it's $100 a month, $200 a month, whatever it is that you're paying, that would be the premium. Your copayment. So this is the amount of money that, let's say you're going to go to see a certain type of doctor. You'll just, when you're at the doctor's office, you'll pay the copay, which might be $10, $20, $40. Who knows what the copay is? It just depends. But it's some flat amount of money that you pay to go see that type of doctor. Deductible. A deductible is how much you have to pay out of pocket before health insurance starts to cover things. So maybe it's $1,000. If you have a $1,000 deductible, you have to pay the first $1,000 out of your pocket. And then after the $1,000, then your insurance will help you pay for your medical bills. So that's what it means to hit your deductible. Once you've hit your deductible, then it gets into co-insurance, right? So once you hit your deductible, you're still going to have to pay some money out of pocket, right? The insurance company isn't going to pay 100% of your medical bills for you, but a typical co-insurance amount might be like 80-20. So the insurance company will pay 80% of your medical bills and you'll pay the other 20% once you've hit your deductible. So let's say you have a $1,000 deductible and you've spent $1,000 out of pocket, and so you've hit your deductible. Then you go to the doctor and you have a $500 bill, a medical bill. All right, well, you've hit your deductible. So if you have an 80-20, 20% of $500 is $100. So you would pay the $100 out of your own pocket, and the insurance company would pay the other $400, as an example. But then you have out-of-pocket maximums, right? So let's say you have a huge medical bill. Let's say, and your out-of-pocket maximum is $5,000, that means the most you'd ever have to pay in a year is $5,000 out of your pocket. And after that, 100% of what's left is covered by your medical insurance. So these are kind of the 5 main terms when it comes to health insurance that you'll want to at least be aware of and kind of see how it works. And we'll go through an example here in a bit. But first, can you build up a 6-month emergency fund and be properly insured? High five your neighbor and say, yes, I can. All right, so let's go ahead and do it. Go ahead and write down what are the action steps that you need to take to make sure you are in the right spot. Go ahead and write it down on the worksheet. Okay, great. So I need 2 volunteers. Let's get 2 volunteers. Go ahead and stand up. I'm going to go to the middle of the room. 2 volunteers. Now, these 2 volunteers are going to do something pretty fun. It's interesting. They're going to have, drum roll please, make some noise. What's it going to be? What are these 2 volunteers going to do? What did these 2 brave people sign up for? Well, it turns out they are going to have a pretend boxing match. Yes, indeed. Boxing match. Keyword on pretend. You're not actually going to punch each other. You're not going to touch each other. This is going to be pretend. So on the count of 3, you guys will start your pretend boxing match, and we're going to see who the winner is. So 1, 2, 3, go at 'em. Okay. All right, we've got the right hook and the left hook, and oh, look at that uppercut. Oh, got hit in the stomach there. Boy, look at him go. Let's give him some cheers here. Looks like a pretty even match so far. Boy, they're really getting into it, aren't they? Look at them go. Boy, they're just, fists are flying. Okay, but it looks like one of them's getting the lead here. Looks like this could be over soon. I sense a knockout coming. Who's going to get knocked out? Oh, one more big punch and... oh, it looks like we have a winner. Yes, we do have a winner. The other guy didn't do so well. We do have a winner and a loser. So the winner, go ahead and put your arms in the air and go celebrate. Perfect. So the winner won and the loser lost. Well, the loser, go ahead and raise your hand if you're the loser. It's okay. We all lose. It's part of the journey to success. Maybe you'll do better next time. The loser, they have to go to the doctor because they just lost. So here's how that's going to work. They're going to go to an in-network doctor, right? So you look at your health insurance plan, you look up the list of doctors, you pick one in the plan, and you go to the doctor and you pay your $20 copay. So you go to the doctor, you pay your $20 copay, he's going to check you out because you just lost a boxing match. He's like, wow, this isn't very good. I'm going to send you to a specialist. So now you're going to go to the specialist and you're going to pay a $50 copay because specialists are more expensive than a general doctor, okay? So you go to the specialist and he says, you're going to need a special $750 treatment, right, to make yourself feel better. So you're going to have to spend $750 on this. Your deductible is $1,000, right? You have not hit your deductible yet. So all that $750 is going to come right out of your pocket. You're going to have to write a check for that $750 to that specialist. Luckily, though, you learned your lesson to not box ever again and so that's a good thing. You learned your lesson. Except you didn't learn your lesson, did you? No, we don't learn our lessons very quickly. You wanted to have another boxing match, so it's round 2, people. So same 2 volunteers, go ahead and get up there. We're gonna have a rematch here, and we're gonna see who the winner is this time. So on the count of 3, we're gonna get those fists ready to go. 1, 2, 3. Here we go. All right, let's give them. Let's cheer them on here. Root for your favorite person. All right, watch those fists. They're swinging. Oh, that was a good dodge there. Boy, look, he is quite good on his feet. They're kind of hopping around, moving in a little circle. They're really getting into this, aren't they? Look at those fists flying. In a safe way, of course. Safe. This is all about safe. Pretend. Pretend, yes. Okay. No one's supposed to get hurt here during these pretend boxing matches. But they're really going at it. Boy, look at the really talented boxers here. All right, I sense the same person who won last time. It looks like they're going to win again this time. They are really dominating. Yep. Oh, looks like another knockout is coming. Oh yes, the same winner as last time. Or same loser as last time too. That's unfortunate. But hey, that's okay. The winner's great. They can go back. But the loser, unfortunately, they have to go to the doctor again. So again, they go to that in-network doctor, and they pay the $20 copay. And this time, the doctor's able to help him himself, but he needs a $1,000 treatment. He's going to have to pay $1,000, okay, to get fixed this time. So first, you paid $750 last time, and so now you need to meet that $1,000 deductible. So you're going to pay that $250 yourself for the first $250. So that means you still owe $750. But because you hit your deductible, your co-insurance is going to kick in. So 80% is going to be covered by the insurance company, and 20% is going to be owed by you. So that remaining $750 times it by 20%, you're going to owe $150 rather than $750. So better deal, right? That's why co-insurance is good. So you owe the $150, and this time you definitely learned your lesson, never to box again, which is good, right? You definitely learned your lesson. Except you didn't, did you? You didn't learn your lesson because you really enjoy boxing. So we're going to go for round 3 here, all right? So everyone, same volunteers, go ahead and stand up. This is your 3rd round of boxing, all right? Hopefully the loser can win this time. We're going to see what happens. So again, on the count of 3, we're going to try the round 3 here. So, 1, 2, 3. All right, you go get them. All right, let's cheer these guys on, all right? They're very high energy. Oh, look at that fancy footwork. Boy, look at those fancy footwork. Man, they are really impressive. And look at those special boxing moves they're doing right now. Super advanced boxing moves that they're demonstrating right now. My goodness, those guys are talented. Boy, they're really getting into this. They're so excited. Look at them jump up and down. Yeah, those are some good boxers. Yeah, okay, I see us nearing the end of the round here. Boy, the winner's still looking really good. The loser from last time, though, he's making a comeback. They're making a comeback, yeah? But nope, it's not enough. It's not enough. The round is over. The same winner as last time won again, and the loser lost again. I'm sorry. Sorry to say that. And now got to go back to the doctor again. This time, though, you really got beat up bad because this was your 3rd round. You did not learn your lesson, so you have to go to the emergency room, and that copay is $100, right? That's much more expensive. And now you need a $30,000 surgery. Boy, I mean, you just really got messed up. So this is going to be expensive. Now, you met your deductible, which is good. Now, regular copay, using the 20% copay, you would owe $6,000. That's a lot. You should have learned your lesson, but you didn't. So now you're going to, if it was just a straight copay, co-insurance. That's supposed to say co-insurance, not copay. I'll have to fix that. So your 20% co-insurance would be $6,000, which is a lot of money. But you have an out-of-pocket maximum. Okay? Your out-of-pocket maximum is $5,000. So let's see what you've paid so far. So you've paid, the $20 copay, the $50 copay, the $750, the $20, the $250, the $150, the $100, from your previous boxing matches. So you've already paid about $1,340 out of your pocket already. And your out-of-pocket maximum is $5,000. So basically, your $5,000 minus your $1,340 equals $3,660. So you're not going to have to pay that $6,000 coinsurance amount. You're only going to have to pay the $3,660 amount because of your out-of-pocket maximum. That's kind of how the math works on all this stuff. And now that you've hit your out-of-pocket maximum, you basically have free medical care for the rest of the year as long as you're using in-network doctors and it's not elective, right? So you can't go get plastic surgery for fun and expect to get it for free, right? That would be an elective procedure. But if you really kind of have to go to the doctor, then you've got you hit your out-of-pocket maximum, so you don't have to pay any more money. And this time, you definitely learned your lesson not to box ever again. You learned your lesson, you're not going to box ever again, for real this time. So luckily, you finally learned your lesson. So that's kind of how all those terms work together and how the math works. Next, death and taxes. All right, in this world, nothing is certain but death and taxes. That's a very common quote that many people say. So let's talk about the 4 Ds. Divorce, death, disability, and default. Okay, do you have a plan for each one of these? All right, these are all different kinds of disasters. We're preparing for the worst. So this is especially important if you have a business partner, right? So what happens if they get divorced, if they die, if they get a disability, if they default? And default is basically bankrupt. You go bankrupt. So this is especially important in a business relationship, but it's just general and true. It's just important in general. Okay, so you want to make sure. Do you have a plan if something were to happen? If one of these 4 things were to happen, do you have a plan in place? Now, one type of plan you can have is an estate plan. All right, so let's go through some estate planning basics. Basically, this is to say what's going to happen when you pass away. That's what an estate plan is. First step is to make sure you have a will. So many people don't have a will, and it's so scary. It doesn't matter how old you are, how much money you have. You always want to have a will. In your will, you want to list out all your assets and liabilities. Okay, so you want to have a list of, I have this savings account here, I have this credit card here, I have this loan here. Because what's going to happen is you're going to appoint an executor of your will. So that's the one person who they basically gather up all your money, pay off all your creditors, pay off all your bills, and then whatever money's left over, they'll distribute it to whoever you said you wanted to distribute it to. So in a will, you can say, I want this person to have this object. Maybe there's a watch, or maybe there's family heirlooms, and you want specific people to have certain things. You can put that in a will. And the executor is in charge to make sure that your wishes take place. Now, if an executor doesn't know where your money is and where your liabilities are, they're not going to have any idea what to do. So that's why they need an updated list. You also might want to have a living will. So a living will is for health care. All right, so let's say you get in an accident and you go into a coma. All right, well, that is sad. But what can happen is you might need some sort of a medical procedure, but you've never talked to your family about what procedures you may want, right? So common things might be, let's say you're in a coma, and how long do you want your family to pay your medical bills for you if there's a chance you're never going to wake up again, right? How long do you want them to keep you alive before they pull the plug? Right? This is not a pleasant thing to think about, but it's important to talk about and to discuss so that they know what's going to happen. Because what could happen is, let's say that there's some sort of medical procedure that you may have a religious objection to, or maybe you don't ever want to be on a respirator, or maybe you're opposed to certain types of feeding things that they're going to do to you, or whatever. It doesn't matter what your medical wishes are. It's important that you communicate them, though, and you do that through a living will, because that's a legal document, And that way you can use it, because if you don't let people know what your wishes are, let's say one parent wants to do one thing and another parent wants to do a different thing, they might actually go to court over that and have to battle it out. And you don't want that. You want to make sure that your wishes are well known so that there aren't arguments, because they're all going to be, your family is going to be under enough stress. If something did happen to you and you're in the hospital, you don't want to add additional stress for them to figure out what your wishes would have been. It's just much easier to have a living will that states what your wishes are. Another one is a durable power of attorney. There's two kinds of durable powers of attorneys. One is for healthcare and one is for your finances. What this is it gives you you're giving someone else legal authority to make decisions on your behalf. Okay? So you may say, well, if I get in the hospital, my parents can, take care of me, but they don't necessarily have the legal authority to do that, right? It's going to be the doctors or the hospitals or the court's final decision as to what happens with you. Okay? Especially if you don't have a living will, your parents may not be able to have that legal authority to actually tell the doctors exactly what to do. But if you assign durable power of attorney to either a friend, to a friend you trust, to a family member, you literally have to trust them with your life, because they're going to be making life or death decisions on your behalf. So that's a healthcare power of attorney. Then there's a financial power of attorney, which you can give them access to your bank accounts. Because if you're in the hospital, you're still going to have bills to pay. So who's going to transfer funds? Who's going to pay bills? Somebody has to do it. And if you don't appoint anybody, then while you're in the hospital, your bills might not get paid. You could lower your credit score. Bad things could happen. So those are two things you may want to consider getting. And are your important documents in a safe place, right? Are they at a minimum in a fireproof box, underneath the bed, or are they in a safe deposit box at the bank, or, are they in one location so that they're easy to access? And if the house burns down, you don't want them to burn. So having them all in a safe place is important. Next, you might want to figure out if you need a trust or not. There's a few reasons why you might want a trust. Basically, one is to avoid probate. So when someone passes away, they go through what's called the probate process, and it can be a long, expensive process. Basically, the will becomes public record, so there's no really amount of privacy, and so a lot of people just want to avoid the probate process altogether, and you can do that with trusts. Let's say that you want to put restrictions on your money. So let's say you have a large amount of money, and let's say you have a child that is a spendthrift, right? So if they got a bunch of money when you passed away, they would just spend it all right away and there would be none left over. So if you want to put restrictions on that money, such as they get a certain dollar amount after a certain age, or in order to get a certain amount of money, they have to have certain grade point average, or whatever kind of restriction you want to put on it, trusts allow you to do that. And then you would assign a trustee, which can either be a person or a company, to make sure that your wishes are carried out. If you own property in a different state, you don't want to go through their probate process, so putting it in a trust could make a lot of sense. And if you're a multi-millionaire, you'll definitely want to use trusts for different tax reasons and legal reasons. So you want to speak to an estate planning attorney to work all that out. Next, you may want to have a letter of instruction. So you'll have your will, and that kind of tells people where you want their money to go, but a letter of instruction, if you were to pass away, can be very helpful. For example, what do you want done with your social media accounts? What do you want done with, whatever, right? So you can have a step-by-step instructions for someone to follow to make it very easy for them, right? Where would you want to be buried? Where would, all these types of things can be done in a letter of instruction to just make it easy for people. You could also do an ethical will. So an ethical will doesn't talk about so much about the money. It talks about kind of your wishes. So what values do you want to pass on to family members? What do you want them to remember you by? What special messages do you have for different people? Things like that. That allows you to cover that in an ethical will. And you want to think about do you want to give to charity? What do you want your legacy to be? When you're going through the estate planning process, you can think about those types of things. So let's talk about some common estate planning mistakes. You always want to avoid mistakes, so what are some mistakes you want to make sure that you avoid? Not updating your estate plan, not updating your will, etc. when there's a marriage, a divorce, when there's kids, a death, things like that. When major events like that happen, you want to make sure that you update it. All right, next. Having the wrong beneficiaries or wrong joint tenancy accounts. So here's a common example. Let's say you get married, and so on your work life insurance and on your work 401k, you put your wife as the beneficiary. Makes sense, right? That's what you would do. But then you get divorced. And so you divorce the one person, then you remarry again, you marry a new person. Okay, great. Well, if you were to die and you didn't update your beneficiaries on your accounts, your ex-wife is going to get all the money in your 401k and that life insurance, which could be hundreds of thousands of dollars, and your current wife is going to get nothing. That is a big, big problem. Okay, so you want to make sure that all your beneficiaries are updated. Same thing with the joint tenancy account. So let's say you open an account, it's a joint tenant account, and then for whatever reason, after years go by, you don't talk to that person anymore, or you get a divorce, or you break up the business partner relationship, but you still have the joint tenant account. Well, that other person can just go into that account and take all the money because they have 100% access. That's a problem, right? So you want to make sure you don't have any joint tenant accounts open that you don't want open anymore. Next, not appointing a guardian for your children. So important. Okay, let's say that mom and dad get into an accident and both pass away at the same time. What's going to happen to the kids? If they have not appointed a legal guardian, what's going to happen? You know, one family, there may be arguments within the family to say, well, I want to raise them, or I want to raise them. It could happen that an aunt that nobody likes gets the opportunity to raise the kids, or someone that you don't want to raise them is going to raise them because you never appointed a guardian. Or worse, if nobody wants to raise them, then they might become a ward of the state, and now the government's going to raise them. I mean, how horrible would that be? Right? Just a lot of bad things could happen if you don't legally appoint a guardian. You usually do that through the will, so make sure that you appoint guardians for your children. Not having a plan for your business. Okay, we're going to talk about entrepreneurship in a later module, but if you have a side business or a real business, and what happens if, the 4 Ds again, remember, like what happens if you die or get a divorce or things like that. You want to make sure that you have a plan in place for your business. Who's going to own the intellectual property, right? If you wrote a book or something, who's going to own that when you pass away? Next, giving fluctuating assets to different people. So let's take an example. Let's say you have a $200,000 home and a $200,000 401k. And you're like, okay, well, one child's going to get the $200,000 home, another child's going to get the $200,000 401k. Good to go. Everybody's going to be happy. Okay, that makes sense today. But 10 years from now, what could happen? Well, let's say that the $200,000 401k turns into $300,000. And the $200,000 home, real estate prices are depressed at the time, and it's only worth, less than $200,000. Well, now what was fair is no longer fair. So you want to keep that in mind when you're divvying up assets to make sure that everything is happy, everyone can be happy. And lastly, not preventing avoidable arguments. Let's say that there's that one family heirloom that all your kids are going to want. And you know that they're going to get into a big argument about who gets it. Okay, while you're still alive, why don't you work out that ahead of time so that everyone is happy, so that once you die, people aren't arguing over different things that that they're going to want. It's just maybe better if you do that ahead of time to make sure everyone is at least content with the decisions and that everyone thinks that it's fair, because you don't want big arguments once you pass away. All right, we covered death. Let's talk about taxes. This is a pretty happy module, isn't it? But you know what? These things are important. And most people don't talk about these things, which is why that I'm talking about them, because you need to know them. All right. April 15th. You may be wondering, why does everyone freak out around April 15th? This is tax day when you have to file your taxes. So that's a very important day. But the nice thing is you see a lot of people wait until the last minute. You do not have to wait until the last minute. In fact, oftentimes you don't want to wait until the last minute. So you can start filing your taxes as soon as you get your documents from your employer. You could file them in February if you want. And then you can get your tax rebate back earlier, which we'll talk about here a little bit. So basically how taxes work, in the olden days, right, talking a long time ago, they didn't used to do tax withholding. Basically what they would say is at the end of the year, they would say, okay, here's your tax bill, write us a check for your taxes. And guess what? People didn't have that amount of money. They're like, what? Oh, I didn't save for that. And they couldn't come up with the money to pay their taxes. That is why they started withholding money from your paycheck to pay the tax bill at the end of the year. Because they know people are bad savers, so they're basically forcing you to save for taxes by withholding money from your paycheck. That's kind of why you're not technically paying taxes on every paycheck. They're just withholding that amount of money for you as kind of like a forced savings that you can pay your bill. Which leads to, people that are applying or getting their first job. There's this W-4 form that you have to fill out, and there's this withholding thing with exemptions. And the decision you have to make is do you put a 0 or do you put a 1? And this causes a lot of confusion for first-time employees. So let me kind of cover what this means. The more exemptions you have, the bigger your paycheck will be, and the less money they're going to withhold for taxes down the road. So if you have children, you can get an exemption for every child. So your paycheck is going to be bigger, which is good, right? You want a bigger paycheck. However, that means it's a trade-off, right? So if you have more exemptions, your paycheck will be bigger, but that means your tax bill, you may have to owe money at the end of the year for taxes because they didn't withhold enough. Or the amount of refund you get, the tax refund you get, is going to be smaller. So you have to make a decision. When it comes to 0 or 1, do you want to be on the safe side and have them withhold more money? That way you're not going to have to pay taxes at the end of the year. You're going to get a tax refund, and your tax refund will be bigger. If that's what you like, then put 0. But if you're like, no, I want as much money now, and sure, maybe I'll have to pay taxes at the end of the year, but I'm fine with that. I want my money now. I don't want the government to hold on to it for me. Then you'd put a 1. So that's a personal decision on what you want. Now there's pros and cons of getting a tax refund. So the pro is, if you put the 0 and you're going to get a bigger tax refund, tax refunds are great, right? It's like, oh, cool. Now I have this money that I can spend on stuff. So it's kind of like forced savings, right? They're forcing you to save money, which is cool. But people would argue, well, you're not getting any interest on that money, which is true, okay? So you may want to instead, rather than Uncle Sam just holding your money and not paying you any interest on it, you may want to take that money yourself and invest it. The question is, do you have the self-discipline not to just blow that money on things you don't need? If you have good self-control and self-discipline, then maybe you can take control of your money. But if you don't, maybe it's just better to let the government keep it. Even though they're not paying you any interest on it, it's better to get that refund where you can actually do something with it rather than just blowing it on things you don't need from week to week. Now, when it comes to taxes, you can either file them yourself or you can hire an accountant. You can do something like TurboTax where they walk you through it. Really just kind of depends on what you feel like doing. That's a personal decision. The more you earn, the more you'll pay in tax. Generally speaking. There's always exceptions, but generally speaking, this is true. Now, there's a couple ways you can look at it. You can be upset by that, or you can be happy that you're making more money. And I think it's better to think about, I'm paying more in taxes, but I'm making more money. So I'd rather make more money in paying taxes than make less money and pay less in taxes, Another way that some people look at it is, America has been good to me, and I don't mind paying taxes. Some people hate paying taxes. Some people don't mind it because they're basically giving back to their community. And that's what taxes are. What do taxes do? They pay for our military so that we can be a safe country. It pays for our roads so that we can drive. There's a lot of government services that help people that are all funded by our taxes. So you can either have a negative attitude about paying taxes, or you can just say, you know what, it's fine. I'm not going to let it bother me. Now, in terms of income tax, there can be three kinds. There can be federal, state, and local. So let's look at kind of how federal income tax works. Now, you'll notice there's different types of ways you can file. You can be a single filer, you can do married filing jointly, you can do married, file it separately, or you can be head of household. We're just going to cover the single filers today to see kind of how the tax rates work. So you see there's different tax rates. There's 10%, there's 15%, 25%, 28%, 33%, 35%, and 39.6%. Now, historically speaking, tax rates were actually a lot higher, a few decades ago. So relatively speaking, these are lower tax rates than before. But here's how it works. You'll see the taxable income bracket, the $0 to $9,325. That means on the first $9,325 you make, you owe 10% tax on that. So your tax bill would be $932.50. As you make more money, you pay more in taxes. And you can kind of see how it breaks down here. But here's a misconception that people have. Let's say you make $100,000 a year, and you're like, oh, $100,000, that's in the 28% tax bracket. And that starts at the $91,900 mark. So you may say, well, I'm only going to make $91,899 because once I get more than that, I'm going to be at a higher tax bracket, which means I'm going to have to pay more in taxes on all my money. That's not how it works. Okay, you're only, for any money over $91,900, that'll be taxed at 28%. But for all the money you made between $37,950 and then $91,900, you're only going to be taxed at 25%. So that incremental tax rate is only on that additional income. It's not on your entire income. So don't worry about getting into the next tax bracket. Just try to make as much money as you can. So don't worry about getting into a higher tax bracket. That higher tax bracket is only going to apply to money over that dollar amount. So you don't have to worry about paying a higher tax on your entire income. Some people get confused by that. Then you have state income tax, and you can kind of look up your state here. California is the highest marginal tax, 13.3%. That 13.3% and all these numbers, that is just the highest amount that you would pay. So only people that make over $1 million a year actually pay 13.3% in California. It's not that everybody pays that. It's graduated as well. So the less money you make, the less percentage you pay in tax. But you'll notice that there are some gray states here, Texas, Florida, Washington, etc., where there's no state income tax. That's pretty cool, right? So if you live in one of those states, you don't pay any state income tax. And that's why a lot of people move from New York to Florida, because there's no state income tax there. So just something to keep in mind. Common types of taxes. There's the payroll tax, which we covered in a previous lesson. That's like where they withhold Social Security and Medicare and things like that. We kind of went through an example in a previous module on how that works. Income tax, which we talked about. There's capital gains tax. This is, let's say you buy a stock and it goes up and then you sell it. Well, you're going to have to pay tax on the gain. All right, so let's say you invest $1,000. It turns into $1,100. So you get a 10% return, which is good. Basically, you made a $100 profit. You're going to have to pay tax on that profit. There's a difference between long-term and short-term. If you hold it for less than a year, if you held that investment for less than a year, it's going to be a short-term capital gains tax, which is basically your income tax rate. So that can be pretty high, especially if you're a high earner. That could be in the 30% or more range. If you hold it for more than a year, that's long-term, and the government rewards you for holding. They don't want you to just day trade all the time. They want you to hold assets for the long term, so they're going to give you a lower tax rate. On average, it's about 15% is a long-term capital gains tax rate, but it depends on your income level. So if you're at a low income level, there's 0% capital gains tax, and if you're in a higher income bracket, then it could be 20%. But on average, it's about 15%. You then have property tax, right? That's when you own a home, you have to pay property tax. And you have sales tax. So when you buy something at the store, you have to pay sales tax. So let's look at property taxes. As you can see, it very much varies depending on your state and your county and all those types of things. But this will give you kind of an example of different property taxes. Now you'll notice that some of the states that don't have income tax, they have higher property tax. So there's no such thing as a perfect place for taxes. Even though they're not charging you on tax on your income, they're going to charge you more tax on your property. Kind of a trade-off there. Not always, but sometimes. Let's look at sales tax. Okay, different states have different amounts of sales tax, and there's a couple gray states there. That means that they don't have any sales tax, which is pretty cool. So if you're going on a big shopping spree, maybe it makes sense to do it in one of those states since you don't have to pay any sales tax. Now, there are exceptions, though. Let's say I want to buy a Ferrari, spend $300,000. I can't just go to one of those states and buy a Ferrari unless I'm a resident there. They're going to ask to prove that I'm a resident. You can't just go in for one day and leave and make some exorbitant purchase. I'd actually have to become a resident there in order to benefit from that lack of sales tax. Ways to reduce your taxes. Make some noise if you want to pay less in taxes. Yeah, most people do. All right, so let's go through some ways on how to do that. Through your employer, you can often do a health savings account or a flexible spending account. This is a great way to reduce your taxes. You basically put money into these accounts and you can use them for healthcare. Now, a health savings account is one of the most powerful vehicles as far as taxes go that exist. Okay, you don't pay tax on the way in. It can grow tax-free, and you don't pay tax on the way out as long as you use it for healthcare-related expenses. It's an amazing thing. Even with retirement accounts, you're going to have to pay tax on the way in or the way out, but with a health savings account, you don't have to. So it's very, very powerful. And you can let it grow over time. So some people use a health savings account almost as a retirement account. You put money in there, you invest it, and you don't touch it for 40 years. And now you have this large nest egg of money that you can use in retirement for your healthcare expenses, because most of your healthcare expenses are probably going to become when you're older anyway. Flexible spending account. You just want to make sure that a lot of those accounts, you have to spend the money by the end of the year or you lose it. Going to use it or lose it kind of thing. So you just want to keep that in mind. 529 plan. This is for college savings, which we'll talk about in a later module. But a 529 plan can be a good way to reduce your taxes because there's tax benefits to a 529 plan. Retirement plans. These are 401k, IRA, Roth IRA. Again, we'll talk about retirement in a future module, but retirement plans can be a good way to reduce your taxes. Timing when you take your income. So let's take an example of, let's say a retiree, for instance. Let's say you're working your last year and you make a lot of income, $150,000 right before you retire. And you retire in September and you want to start taking money out from your retirement plan. Well, that's going to be income and it's going to be taxable. Well, if you wait until the next year when you have a lower income, you're going to pay less in taxes. So let's say you have a bonus at your work, and let's say you're a salesperson and your income fluctuates. Rather than getting that bonus in a high income year, maybe wait until the next year to get the bonus, if you're allowed to do that through your job, so that your tax rate is lower. Right? So there's different ways how you can time when you take your income to reduce your taxes. Deductions and credits are a great way to save money on taxes, and there's hundreds of different types of tax deductions and tax credits you can get because the government wants to incentivize you to act a certain way. So there could be, if you buy an environmental thing, such as solar panels or whatever, certain job related expenses, paying for college. There's all types of things that you can do, and an accountant would be good, or one of these tax accounting programs would be pretty good at helping you identify which deductions and credits you're eligible for. But not all accountants are created equal, right? They may miss some of these things, so you'll want to do some research yourself to see what you're eligible for. Donating to charity can reduce your taxes. You're also helping a good cause and supporting something that you want to support. There are things called sales tax holidays, right? So if your state has sales tax, usually around school shopping time, around August, they might have a day where you can buy school supplies and pay no sales tax, or buy all kinds of things with no sales tax. You can just Google sales tax holidays and you can see a big list. Let's say you're an investor and the stock that you bought is down. Okay, it's lost money. So what you can do is you can sell that stock, and the loss that you took can offset gains that you had on other stocks. Or if you don't have any gains to offset it against, you can offset up to $3,000 worth of losses against your income. So, and then if you have more than $3,000 worth of losses, you can accumulate that and let it reduce your income for years in the future. So that may be something. Maybe you buy, you lock in the loss on one stock, and then you buy a similar stock. That way you still get that market exposure. Again, you want to talk to your accountant about that, because there are restrictions cross-selling the same stock, and it gets kind of complicated. But basically, locking in losses can be a way to reduce your tax bill at the end of the year. Using pre-tax dollars to pay for things. For example, through your employer, you may be able to use pre-tax dollars to pay for childcare or public transportation and other types of services. If you can ever pay something pre-tax, that's always better, because it's going to reduce your taxes. One of the best ways to reduce your taxes is to start a business, because you can write off a lot of expenses as business expenses. Again, I'm not an accountant, but let's say that you want to take a family vacation and you happen to go to a place where there's a business conference going on that could grow your business. So you write off a lot of the expenses because it was a business trip. Obviously you need to do business there. But since you already are there, maybe you can take advantage of a vacation. You can't write off the whole vacation, of course, as a business expense, but you might be able to write off some of it as long as you're doing business there. There's lots of expenses that can be business related, and you can save a lot of taxes by spending money you would have spent on anyway. Again, but you need to talk to an accountant, because that can get into a legal gray area, and you want to avoid doing bad things. So can you prepare your estate plan and reduce your taxes? High five your neighbor and say, "Yes, I can." All right, so we went over a lot of information. How are you going to do it? What are the top 2 or 3 action items that you're going to take right away? Write them down on the worksheet. Great. Now you want to make sure you actually take action on those things, because that's the only way that you'll see results. So now we're going to do a little activity, okay? So go ahead and put your hands together so that they're folded kind of like this, right? Now what's interesting is which way you fold your hands and which thumb is on top tells you about your personality. So go ahead and look at your neighbor and see which thumb is on top, whether it's the right thumb or the left thumb. This is important information because you want to be able to make fun of them later based on their thumb. So if your right thumb is on top, that means that you're more of an analytical person and you're likely to become a millionaire. So that's pretty great. Congratulations to all you right thumbers in the room. Now, if your left thumb is on top, that means you're more of a creative person and you are a really good kisser. That's right. That's also a good thing as well. So really, it's kind of a win-win situation. Now I want you to take your hands apart, put them back together so the other thumb is on top. How does that feel? If you're like most people, it feels a little weird, feels a little uncomfortable. Now the reason for that is because you get used to doing something the same way over and over and over again, and it becomes comfortable. Then when you try something different, it feels weird, it feels uncomfortable. Now, when it comes to your personal finances, you're in certain habits right now, and if you want to get to the next level, if you want to make more money, if you want to reduce your expenses, all these things, you're going to have to start doing new things. And those new things may feel uncomfortable at first. But here's the thing. To become successful, you always need to push yourself. You always need to kind of get things to the next level, and that's just a part of success. So rather than being intimidated by kind of these new things and this feeling of uncomfort, start to embrace it, and really that's how you can get to the next stage. Okay, now let's talk about other kinds of disasters. A stock market crash. Let's say a stock market crash happens. What do you do? All right, well, first of all, don't sell in a panic. Right? What a lot of people do is they're like, "Oh, I'm losing money. I'm just gonna sell it when I'm panicking." When everyone is panicking, that's oftentimes like the bottom of the you don't want to sell at the worst point of time, and you can't predict when that's going to be. But just don't sell in a panic. Okay. Remember, diversification is your friend. So we're going to talk about investing in a later module, but having diversification around is going to help you survive these stock market crashes, because you're not going to have 100% of your money in a certain sector or anything like that. Diversification is your friend. If you're in your 20s and 30s or teens, remember that you have a long-term time horizon. So it doesn't matter if the stock market crashes right now, because you have 40 years to recover from it. So who cares, right? That's kind of the way that you want to look at it. There's no need to stress out if you're that young and you're saving for retirement and that money is invested for retirement. I mean, your money, there's never been I think a 10 or 15 year period where the stock market has lost money, right? In the history of the stock market, there's never been a point where you've lost money over that period of time. So if you have a 30 or 40 year time horizon, then you're definitely going to make money over that time. So don't worry about the stock market crash. If you're doing dollar cost averaging, which is a topic we'll also cover, this is basically like a 401k. So you're going to put in a certain amount of money every single paycheck, right? So let's say it's $300, just as a random number. Well, when stock market prices are high, you're going to buy less shares of stock because, it's like, buying jewelry, right? If you have $300, how many cheap plastic bracelets can you buy? For $300, a lot. How many diamond earrings can you buy? Not very many, right? So same thing with stocks. When they're more expensive, your $300 buys less shares of stock. When the stock market crashes, that means stocks are quote unquote on sale, is one way to look at it, and you can buy more stocks for that same amount of money. So when you're dollar cost averaging, you buy more shares when stock prices are down and less shares when they're up. So this can actually work into your favor, right? If you have a long-term time horizon, a stock market crash will get you excited because you're able to buy stock at a cheaper price. So don't worry about a stock market crash if you have a long-term time horizon. Famous Warren Buffett quote is, "Be fearful when others are greedy, and greedy when others are fearful." Okay, what that means is, when everyone's super excited about the stock market, it may not be a great time to invest. It may be, it may not be, right? It's really hard to tell. But when everyone is panicking, that could be a good time to buy. But remember, you cannot time the market, right? So young people nowadays are like, "Oh, I wish I was around in 2008. I would have bought it when it was at the bottom, and it would have been great, and I would have made a lot of money." Okay, it's impossible to tell when you're in a stock market crash when the bottom's going to be. Okay, it's just impossible to know. So you think it's the bottom, and then it goes lower, and then you panic, right? That happened a lot. I lived through 2008. I was on Wall Street at the time, and I saw the whole thing happen. So it's just never, you can never know when the bottom's going to be, because things can always go lower. You also think like, "Oh, well, I'm going to sell before the stock market crashes? Again, it's impossible to know, right? People have been saying for years, people might think for years that there's another stock market crash coming, and it never happens, right? Or it doesn't happen. It happens 7 years later than they thought it was going to, which has happened in the past. So don't try to time the market. Just basically keep investing steadily for decades at a time, and more than likely you'll be fine, right? Rather than trying to time the market or sell during a panic or those kinds of things. Losing your job. Obviously, if you lose your job, you lose your income. And this is a problem. So what do you do when you lose your job? Well, that is why you have an emergency fund. It is there to protect you, right? It's in all cash. So even if the stock market is crashing when you lose your job, it doesn't matter because your emergency fund is there in all cash. It's not losing money. It's making money. Even if it's just a small amount, it's still making money. You want to file for unemployment. I mean, this is basically free money, right? Some people think, I don't want to file for unemployment. People will think that I'm a loser if I'm on unemployment or something. It's free money, so you might as well take it, right? Determine what you're going to do for health insurance, right? If you lose your job and you had insurance before, you can sign up for what's called COBRA insurance, but that's very, very expensive. So you may want to talk to your insurance agent, and maybe there's some sort of temporary plan, kind of an in-between kind of plan that you can do for a few months while you're looking for a new job. But again, you want to have health insurance. You want to reduce your spending and redo your budget, right? Now that you don't have that income anymore, what expenses can you cut? You want to update your resume and start to reach out to your network. Okay, a lot of people apply for jobs online, but the truth is, that might not be the best way to apply for jobs, right? They get so many resumes. A lot of times the computer algorithm is filtering through them to find the right things, and they don't know who you are. So a lot of times the best way to get a job is through your network, or go to networking events and talk to people. But really through your existing network is a good way to get jobs because they know of opportunities. They can recommend you. They can be a reference for you. They can get you an interview with a person because they're friends with the person. Things like that. That's oftentimes a better way to go about getting a job. And that's why you always want to stay in contact with your network, right? So what happens a lot of times is you don't hear from a friend for years at a time, and then when they need something, you hear from them. You don't want to be that person. You always want to keep in contact with your friends and keep up to date with your network, and always keep your ears open for opportunities, right? So that way, if you were to lose your job unexpectedly, you kind of already had feelers out there to know what was going on. Or maybe you're not looking for a job, but an amazing job comes up that you hadn't even thought of, that you wouldn't have heard about if you hadn't been keeping in contact with your network. So it's good to keep in contact with your network. Applying for jobs is a full-time job, okay? It's a lot of work to apply for jobs. So just keep that in mind, right? You want to make sure that you set enough time. Some people think, I lost my job, so I can have some free time now to relax and whatever. You might have some time for that, but you really need to have the mindset of like, wow, I really need to work hard and make sure that I can get a new job because it is a full-time job. Maintain a positive attitude, right? That's very important. It's very easy to get discouraged when you lose your job and you're searching for a new job. So just always maintain a positive attitude. Have a plan in place while you're still employed, right? Again, this is at some point people lose their jobs. Like this is a normal thing. So have a plan in place for it to happen while you still have a paycheck, right? So maybe you have a backup plan ready to go. Maybe you have a side hustle. Maybe you have a part-time job that can turn into a full-time job if you were to lose your main job. You've already reached out to your network. You kind of know where the opportunities are. Your resume is already updated. A lot of times when you lose your job, it's not out of the blue. You kind of see it coming in a little way. So while you still have your paycheck, put a plan in place. All right, when it comes to investing, again, we'll cover this more later, but you don't want to have all your money in your company's stock. All right, this is just not a good idea. So in the olden days, people would put 100% of their retirement fund in their employer's stock. That's not necessarily a good idea because what could happen is, let's say you have half your money in your employer's stock, and then that industry gets hurt due to the economic reasons. That company's stock goes down a lot, and because their stock is down, they have to lay off employees. So now you lost your job, Plus, you lost most of your retirement savings because it was in your employer's stock. It's just too much risk in one company. So that's why it's usually a good idea to diversify. And in general, you wouldn't want to have more than 10% of your savings of your net worth in one particular stock. That's just a general guideline that people sometimes give. Losing your job might be a good thing for you, right? At the time, it might feel bad, but if you lost your job, that probably means you didn't get along with your coworkers, you weren't very good at your job, which probably means it wasn't your true passion, wasn't a good fit. So sometimes people say getting fired was the best thing that ever happened to them, because now it forces you to get a new job, and it could be a great opportunity for you to start over and do something that you love, right? Most people don't just voluntarily quit their job because they need that money. But when you're fired, this gives you a chance to do something that you're really passionate about. And some people are much happier after being fired once they find a job that they love than they were when they were at their previous job. So maybe try to have that silver lining mentality. Okay, your purse or your wallet was stolen. This is bad. What do you do? Well, first, is it really stolen or did you just misplace it? A lot of times people freak out like, oh, my thing was stolen, when really it was just hidden in the couch. Now, there are tracking gadgets that you can do. So you can put a little tile in your purse or your wallet, and then you can call it from your cell phone. Okay, so you can actually dial it. It'll make some noise like, oh, there it is. It fell behind the bed or whatever. So first, is it really stolen? You want to make sure that you inventory all your items in your purse and your wallet. In case it does get stolen, you know what was in there and what was missed. So you also want to have phone numbers of all your credit card companies, debit card companies, any other types of information in your wallet, so that you can contact these people. You want to call your credit card and debit card companies and report those cards as being stolen. Don't just cancel them, okay, because that could affect your credit score. Just tell them that they were stolen. They can place a hold on them. You can put a fraud alert or a credit freeze with your credit bureaus. We'll go into that more later, but that's something that you can do. You want to file a local police report. You may say, oh, that seems like overkill. I just lost my wallet, or my wallet was stolen. I don't need to bother the police. But there are benefits to that. And so it's usually worth filing the report. Monitoring your credit report. You should be doing that anyway, but you especially want to do it if someone just stole your wallet, to make sure they're not racking up charges. If your keys were stolen, you want to make sure you change the locks to your home. Okay, that's very important. Don't carry your social security card or PIN numbers around with you, right? There's no need to carry around your social security card most times. And if your ATM card and your PIN number are both in your wallet, it's going to be real easy for them to just wipe out all your money. So don't keep them in the same place. Identity theft. This is a big problem nowadays. What can you do to help prevent identity theft? Have strong passwords, okay? You can Google, what a strong password looks like, but you want to make sure that you have strong passwords especially for your bank accounts. Phishing. This is kind of like you get an email, it pretends to be your bank account, from XYZ Bank, and it says, click here to reset your password. And it looks like it's from them, so you click the link, you put in your password, then you get some weird error, and basically that email was not from who you thought it was from somebody different. So you always want to make sure that you trust the emails that you're opening, kind of look at who it's from. Right, so if the address is xyzbanking.com, but the real bank is xyzbank.com, right? They just bought a domain name that looks similar. That's obviously a red flag. If you don't know why they're emailing you in the first place, if it's just kind of out of the blue, that's a red flag. So you want to make sure that the email that you're opening is actually from the person, because you can get emails from friends saying, hey, click this link. This is funny. And it turns out that it wasn't from your friend. They just pretended it was from your friend. And now you clicked a link that had a virus in it or whatever. Social engineering. This is where someone pretends to be someone that they're not. So a common example might be, let's say you're at work. You get a phone call saying, oh, this is Fred from the tech help desk. I just need you to do a few things for me. You're like, oh, okay, sure, Fred, what's going on? And they have you click here, click here, click here. You have no idea what they're doing because it's a tech person. Turns out that guy was not from your company, and he just hacked your company's computer system, right? So that'd be an example of social engineering. So you always want to be skeptical. Make sure that who you're talking to is actually who they say they are. Get your mail promptly, right? Someone can just take mail from your mailbox, and then they can steal your identity in some cases. So you always want to get your mail promptly, and always shred all your documents. You get these credit card offers in the mail all the time. Don't just throw them away in the garbage, because someone could go dumpster diving, pull those out, pretend they're you, fill out those applications, send them in. That's why you want to shred those documents. Obviously, you want to monitor your bank and credit card statements for any unusual activity. Don't sign up for sketchy things on the internet, right? You get these banner ads, you go to these weird sites, and you click these things, you fill out these forms, and then all of a sudden they steal your identity. Okay, be very cautious of that. If you're going to buy things on sketchy sites, which sometimes, right, not everything is sold on eBay and Amazon. Sometimes you have to go to these sites that look fine, but you really don't know, right? I mean, anyone can put up a decent looking website, but who knows what's really going on behind the scenes. So what you can do is you can sign up for these temporary credit card numbers through certain credit card companies, or you can just buy a Visa gift card at the local Walgreens or CVS or whatever. Buy a $100 gift card and use that to make the purchase if you don't trust the website. Right? That can definitely reduce identity theft and credit card fraud and things like that. If you're going to give away your computer or your cell phone, make sure you clear the data ahead of time, and not just delete it, but really destroy the data. You can't just hit delete, because people can, technology people are able to kind of undo that delete, basically. So I don't have time to go into the details on how to do this. You can look on the internet, but you want to make sure you properly dispose of sensitive data that might be on a computer or a phone. Don't email sensitive information. So if someone's like, oh, fill out this form and send it back to me, and the form has your social security number and credit card number and all these types of things, if you just email that as an attachment, that is not a safe way to communicate data. Sometimes sending a fax is safer, right? So people can't really hack faxes. So sending a fax with that information might be safer. You just want to make sure that the person is expecting the fax, because if you're in an office and there's 10 people working there, you don't want someone to just swipe your information from the fax machine. You want to make sure that the right person gets it from the fax machine. If you're going to email sensitive information, make sure that it's password protected. There's different programs out there that allow you to do that, to send a secure email. For your social media and online accounts, set up two-factor authentication. So this might be, let's say you log into a social media account, you're going to reset your password to make sure that it's you. You're also going to get a text message with a certain code on your cell phone. So you get it on your cell phone, you type in the password from your phone, and now they know that, well, you know that you knew the password and you have that phone, so it's probably you. That's like an example of a two-factor authentication. It can be much safer because you don't want someone to hack into your accounts, pretend they're you, and cause a lot of trouble. You can sign up for credit monitoring services. These are hit or miss. Like these credit monitoring services or identity theft services, they can't prevent someone from stealing your identity, but they can monitor it and give you some sort of protection or some financial compensation if it were to happen. Some of them are kind of a joke and they're overpriced. Some of them are valuable. You'll just want to do your own research on those. All right, so let's look at credit bureaus. You can do a fraud alert versus a credit freeze. So these are two options to help prevent against identity theft. A fraud alert is usually a temporary thing, like if someone just stole your credit card or whatever. This is free. It makes the lender verify your identity. Basically, it's in 90-day chunks, and you can renew that if you want. They're difficult to reverse, and it doesn't have an effect on your credit rating. That's like a fraud alert. A security or credit freeze, this might cost money to initiate. Basically, this locks your credit. Okay, it lasts indefinitely, so it could last for forever if you wanted. It's easy to reverse and no effect on your credit rating. These are two options when it comes to the credit bureaus, and depending on the situation, you may or may not want to use one. So let's just take an action right now. Can you inventory your wallet and purse items right now? Okay? Of course you can. High five your neighbor and say, yes, I can. So let's take this minute. Let's write down what's everything in your purse, what's everything in your wallet. That way, in case you were to lose it later today or if it were to get stolen, you already have the phone numbers ready to go. You know what's in it, and you can be prepared. Okay, great. Now put that in a safe place. Maybe you store it in your phone for access to it. That'll be very, very helpful to have. Okay, so what lessons did you find most valuable today? What questions do you still have? What actions are you going to take? Let's go ahead and take a minute, a couple minutes, to share. Share with one another. What actions are you going to take? What lessons did you find the most valuable? And if you have any questions, you guys can help each other answer those. So go ahead. All right, so now it's time to take action, okay? What is your take action SMART goal for this week? What action are you going to take? Remember, you have that 8-week goal that you set. So what action are you going to take this week, or what actions? You can do multiple actions based on what we covered. What action are you going to take this week? What is your SMART goal? Go ahead and set it right now. Great. So here's your homework. Set up and automatically contribute to your emergency fund. You want to start building that emergency fund, definitely. See if you can save money on your insurance. Right? There's lots of insurance companies out there on different types of insurance, so see if you can get a better deal. Put together your estate plan. Try to reduce your taxes. Reduce your risk for identity theft. Continue to follow your budget. Continue to have an unstoppable mindset. Take action towards your 8-week SMART goal. Read chapters 16 through 20 of Pirates of Financial Freedom. And get excited for next week. Going to be lots more lessons then. So that's all for this week. So now, go dominate your finances.